Hey, what's up guys, it's your boy Kevin here, and today we are going to learn about the exchange rate, the pips and lots. By the end of this video you'll have known what the pip is, what a lot is, and what an exchange is. In this part 4 of Forex trading for beginners full course, we are going to learn about the exchange rate in Forex, examples of exchange rate in Forex, what is a pip, why gold and yen pairs are different, how to calculate pips, how to add and subtract pips, what is a pipet, how do we profit in Forex, what is a lot size, types of lot size, how to calculate lot sizes, summary of lot sizes. So as usual, this is a disclaimer. Now, before you decide to trade any Forex, you should carefully consider your investment objective and level of your experience and risk appetite, because Forex is risky. So the possibility exists that you could sustain a loss of some of all your initial investment, and therefore you should not invest money that you can afford to lose. So you can read that disclaimer over there, and you should know that Forex is risky. So what is an exchange? Exchange rate is the rate at which one currency is exchanged for another. It also means that the rate that buyers pay in order to exchange the currency for a different currency. Like we saw earlier, in an exchange, we normally exchange one currency to the other. So there must be two different currencies like we saw in the earlier videos. So now an exchange rate reflects the conditions of one country's economy compared to another country's economy. With the US dollar and Great Britain pound, so we see it reflects the economy of these two countries, or countries in Great Britain and countries that support the US dollar, right? That is US. So this rate exchanges over time due to forces of demand and supply, and the market participant constantly buy and selling currencies. So example of a live exchange rate is as follows. So as you can see here, USD, they're buying and selling. So for this exchange, they buy using this and they sell using this. So if you want to buy, they will sell you this, but if you want to sell them, they'll buy using this. So when there is a high demand of a particular currency, it causes the increase in exchange rate on that particular currency, and the opposite is true. So if there is a demand on one currency, then it causes an increase of an exchange rate on the water. So it's just like buying and selling, because if there is a demand on something in the market, then that means that the price will be higher. But if there is no demand, then the price will go down, right? The same happens with the currency that we're dealing with here. So when there is a high supply of currency, it causes the lower exchange rate on that currency, and vice versa. It's just the way we have discussed, right? So an exchange rate is the ratio of one currency valued against another currency. So Euro USD is an exchange rate in case how many euro can purchase $1, or how many dollars you can use to buy 1 euro. An exchange rate breakdown. So we're going to break down the exchange rate here, or we're going to take the pair of Euro USD as is equal to 1.8273. 1.827739 is now we want to see what this means. So the 9 over here is a pipet. So as you can see here, this one represents a pipet, this one represents a pip, the two represent a pip, and this one represents a cent, and this one represents a dollar. I just want to show you what that is. As you can see here, now these are the bid and the ask prices of the currency. So this is pipet, and the two here we've seen that these are pips. So the last one is a pipet, okay, and the two here are pips, and then the two here are cent, and this is a dollar, right? So this is the kind of representation of the cent. So this is a pipet, and these are pips, and this cent, and this one is a dollar. So the one that is changing each and every time here is a pipet. So if you can look at this, the one that changes more is a pipet. So and the two here are pips, and this here are cents. So this is the changing in prices. They're the changing in prices as you can see. This is the market watch of all the currencies that we have. As you can see, the currency normally goes up and down, and here we are in Euro USD. It goes up and down. So whenever it goes up, then there is a change of some prices. Let me just zoom a little bit for this pair. As you can see, the pair goes up and down. So this is what is a representation of Euro USD, which is this one here, Euro USD, on a 1 minute time frame. on a 1 minute time frame, this is how the market is faring. So as you can see, the pipet, the pips, the cent, and this one is called a dollar. So that is what is happening here. What is a pip? Pip is a short form of percentage in point. It is the percentage of a cent in a given exchange rate. It is the unit of a measurement to express the exchange in value in the market. It is the smallest amount by which currency exchange rate can exchange, and it is the most common increment of currencies. It determines how you measure your profit or loss in a current market. If you want to measure your profit and losses, you measure them through the pips. We don't measure it through a pipet, because the pipet is like a second or over time. Then we have seconds, minutes, and we have hours. Now this one now act like the seconds, but the ones that we normally look for is the two, which are pips. It is the smallest amount by which a currency exchange rate can exchange, and is the most common increment of currencies. If you're buying and selling currencies, or if you're trading Forex, then what you should look for is the pips. The changes in the prices according to pips is what you will term as your profit. There are type of pips here, right? For yen and gold pairs and any other normal currency. So as you can see, this is a JPY. You see, it's a different one. Each and every symbol without JPY has 5 digits. So you see, this one has 5 digits, this one has 5 digits. But when we see any pair with the JPY, then it is 3 digits. So that's what we're going to look at. But I just want to show you here before we go on. And it's just the same thing with gold pairs. So before we come to the gold and yen pairs, I just want to show you something here. Then you understand what I'm saying. Any other pair, we see that we have five digits here. And we have 5 digits, and we have 5 here, we have 5 here, we have 5 here. So any other currency apart from the JPY, we see we have 3 digits. Any pair with the JPY, we have 3 digits. Just want to show you another one here. JPY, we have 3 digits. As you can see, any JPY. This one, we have 3 digits. This one here, we have 3 digits. But this one, which is not JPY, we have 5 digits as usual. And I also want to show you a gold pair, XAU USD. So any pair with XAU, this is a gold pair. As you can see here, this is a gold versus US dollar, this is a gold versus euro, this is a gold versus US Australian dollar. XAU, that means that is a gold. And we see gold, we have only 2 digits at the end, right? So it is the first digit after the decimal place. That's what a pip is. After a comma in an exchange rate, except for gold and yen pairs. So we saw that the gold is 2 digits after the decimal place, and in the yen pairs is 3 digits after the decimal place. For the yen pairs, it is the second number after the decimal place, right? And for gold, it is the first digit after the decimal place. So we see pips for yen pairs, the second digit after the comma is a pip. The second digit is a pip. So, and therefore the last one would be pipet. And then the pipet becomes the last digit. So for any normal pair of currency, we see that we have 5 digits over here, right? So which the 2 ones here are the cent, and the following 2 are the pips, and the last one becomes a pipet. So it's kind of different with the yen pairs. That's what we're looking at here. So for the gold pairs, we only had 2 digits at the end after this point here. Okay, so for the gold pairs, the first digit of the comma is a pip, right? So this one now it becomes a pip, while the second one becomes a pipet. While in this one, the 2 become pips and the last one becomes a pipet. And for the normal currency, the pip is the last one, then the 2 are the pips, while the 2 here are the cents, and the last one is a dollar. So it's kind of different for gold and yen pairs. We're going to see, or we're going to look at how we can calculate the pips. For example, if you enter Euro USD at this point, at this price, right, and exit at this price. So the question is, how many pips will you have achieved before you exit? So that will be this amount. This amount, because this is the largest amount, less this amount. Our answer will be 0.00205. So 0.00205 divide by 0.0001, we get 20 pips. Another way is to move the decimal over 4 places to the right, So you come 1, 2, 3, 4. We get it as 20 20.5 pips, because we say that the last one is a pipet and the third and the fourth digits are the pips. So we find that this is 20.5 pips. So this, because the pip is always the fourth digit, the first, second, third, and fourth. Now this where the pip is starting from. So the two here is the pips, and while the last one is a pipet. This is because a pip is always the fourth digit to the right of a decimal. Therefore, you get 20.5 pips. The last digit is called the minimum change. The minimum change that any currency can experience is 0.001, which is a 1 point or a 1 pip. So the minimum change is 1 point. That is the minimum change you can trade in Forex. So the minimum change is 0.001 pip, because it's 1 pip is equal to 0.001. Therefore, 1 point is equal to 1 pip. How to add pips? The previous example we subtracted pips, but this is how we add pips. For example, if you have Euro USD at this price and you're told to add 5 pips to 1.5647, in this way you profit your trade by 5 pips. We saw that the last one was a pipet, so the pip starts from fourth digit after the point. So if you do your additional here, you'll get it as 1.56597, because we added the 5 pip in where the pip is starting from. But when you are told to add 15 pips, then you will add 5 here. You're not going to touch the 7. So this now will be the newest price. So that means we entered the market when the price was this, and we exit the market when the price was this. We made a profit of 15 pips. So that is how we add pips. So if it was this chart, right, and we entered the market when it was here, right? So we entered the market when the price was down here, and when we exited the market up here. So the calculation between the previous price and the current price is what we call the pip. That's what is being explained here. And how to subtract pips is just the same way, but now you have Euro USD at this point, and you are told to subtract 5 pips from this. In this way, you lose the trade by 5 pips. We just take our previous price, and then we'll subtract 5 here, then we'll get this. It's just a normal subtraction, and that's how we calculate pips. So when you are told to subtract 15 pips from this, then this is how you lose your trade by 15 pips. So you lose your trade because maybe you predicted the price movement to go up, and then it went down from this to this. Then it is said that you lost 15 pips on that trade. So the difference in pips addition for yen pairs, as we saw, yen pairs is different from any other currency pair, because in yen we only have 3 digits after the point. You are told to add 5 pips to this, then this is how you'll do it. So we assume that the last one is a pipet and the 2 are pips. If you do your calculation there, you'll get that it's 135.615. So when you're told to add 15 pips, now you'll add it here, right? Because this one is a pipet and the 2 here are the pips. If you do your maths correctly here, you'll find that is 135.715. The difference in pip subtraction for yen pairs is just the same, but now we do our subtraction from this price here, and then we find it this way. But when you're told to subtract 15 pips, then you'll find it is less 15, so you get it like this. So the last one we don't count it because it's a pipet. It's like a second on your watch, but this one is like minutes and this one is like hours. So the difference in pip addition for gold pairs, and we saw that the gold pairs we only have 2 digits at the end. We only have 2 digits at the end, like this one. This is the gold USD. We only have 2 digits at the end. So the last one now becomes a pipet and this one becomes a pip. So if you add 5 here, you'll get something like this. But when you're told to add 15 pips, then the 5 starts here is 0. This one becomes 7. So it's 1377.06. So the difference pip subtraction for gold pairs is just the same. You subtract 5 here, you'll get something like this. If you subtract 15, then you'll get something like this. So we don't normally use the last one because this one is a pipet. What is a pipet? Now we want to see what a pipet is, because we've been talking about pipet, but now we want to know what a pipet is. Pipet is a smaller unit of a price movement beyond the standard pip, while a pip is typically represent the smallest price move in most currency pairs. A pipet is 1/10 of a pip. So if you see something like this, so a pipet like this one here, now this one becomes the last 1/10 of a pip. This now like a second. A pipet is 1/10 of a pip, and this is also sometimes referred as fractional pip. In most major currency pairs, a pip is typically equivalent to 0.001 or 1/100%. A pipet, on the other hand, is 1/10 of a pip, so that would be 0.0001, which is a tenth of a pip. So this is a pip, and this now becomes the pipet. So some brokers provide the prices that are up to 5 decimal figures after the comma. The pipet is the 5th digit, which is this one. In this case, the pipet is 7. So this one, it's the price movement. They move fast. Now, how do we profit in Forex? So having learned about the pips and pipet, we now want to look at how we normally profit in Forex. So this is the fundamental of Forex trading. You have to know how you are profiting from all your trades or about to trade. We profit in 2 ways. When buying, we get the profit when we buy a currency when the prices are low, and then sell the price is high. That means after the price has increased. It's just the normal, like a business. You buy low, you sell high. And when selling, we sell the currency when the price is high and buy back when the price is low. For example, I want to make a profit in selling my product. I'll actually find a company that sells the product low, and then I'll buy it from there and then put the price high when selling, so that I profit in between the buying and selling. And it's just the same thing that is happening in Forex. We profit when buying. For example, when the exchange rate of Euro USD is this, it means that 1 euro is exchanged for 1.56547 USD, or 1 euro is equal to this USD. So when we buy 1 euro, we pay this amount. Therefore, in this case, we'll hold 1 euro we have bought until it changes the price upward. This is where we add the pips, because any price movement upwards will add these digits here, and then we profit with pips. So after some minutes of second, you may find that the exchange rate has increased by 20.1 pips, which brings our total to this. This will mean that the euro have become strong against the USD, and we therefore need to sell back the euro, and we have that our USD back. We sold this and we got this euro, and then after 20.1 pips, the price changed to this. So this is now our price. Then we sell this, we get back our euro. So the exchange rate is euro USD. This means that you'll get 1.5674 USD instead of 1.5647, because there is a price movement in 20.1 pips. So that we paid previously bought, and that means we have made a profit of 0.0021 on that trade. It's just the same when selling. For example, when the exchange rate is this, that means 1 euro is equivalent to this or equal to this. So we expect that the price will soon drops by this. Now we are selling, and then we find it to this. That means that euro is getting weaker against the US. So what we do now, we sell now the euro and buy back the USD. So the price drops by this to this, and we exit the market. This means that we are buying back our euro at more cheaper price, and we have made a profit of 0.0021 on that trade. So we therefore need not to hold the euro because its price is dropping. We'll therefore sell it while we sell the euro. We're simultaneously buying the USD back, because USD we are holding is getting stronger. It's just like buying and selling stuff. Now it brings us to another thing called a lot size. So what is a lot size? A lot size refers to the volume or quantity of a particular currency pair that you're buying or selling in a single trade. So lot size determine the size of your position, consequently the potential risk and reward of this trade. Some brokers offer even smaller lot sizes, such as nano lots, which is 100 units, or fractional lots, which can be useful for precise position sizing and risk management. The choice of lot size depends on your trading strategy, risk tolerance, and the size of your trading account. The larger lot size can result in a larger profit or losses. So it's important to consider your lot size when entering the trade. Proper risk management is essential in Forex trading to protect your capital. So this is now the introduction of a lot size. If you haven't understood what a lot size is, it is just just a volume or quantity that a particular currency pair can be sold in a single trade. So the lot sizes now determine the size of your position. Okay, and some brokers offer smaller sizes of lot size. This can be useful for precise position sizing of your risk management. So we're going to see what a lot size is and how we can profit with that. We have seen in our previous example that we get a very small profit, like 0.001. Now this is over $1. So this is a small profit when trading. So when you buy or sell 1 unit of a currency, and when you get 20 pips, this is what you'll get, right? So this now is in terms of $1. But what we should know is that this is because the currency is measured in pips to gain the movement in pips in order to calculate our percentage in profit. So which is the smallest increment of that currency? As you can see, 0.0021 over $1 is a very, very small profit. We'll see what a lot size is and why lot size can make us rich when we are trading Forex using the smallest trades. Now, to take advantage of these tiny increments, or like 0.000201, you need to trade a larger amount of a particular currency to see any significant profit or a loss. So that means if you make 0.001 over $1, then it will be nothing, right? But if you use that tiny increment on a lot size, then we'll see how you profit more. You're making your profit in lots. So to get at least, now this is an example, now to get at least 20.1 in that example, we need to buy 1,000 units. So 1,000 units multiplied by 0.00201, which is 20.1 pips, we find that we get now $20. So we are now not getting like 0.00201, which is a percentage of is a fraction of $1, but now because of now the lot size, we find that we now get $20.1. Lot in Forex. Now what is a lot? Lot in Forex refers to a specific amount or number of currency units or bundle of currency that you'll buy or sell in the market. So you can't be a profitable Forex trader if you don't trade using lots, because if you get like 100, let's say you get here like 100 pips, right? So if you trade without a lot here, then that will be 0.0100. But if you trade with a lot, then 0.0100, like 100 pips, now will be $100 because we're now trading with lots. So that's how we make profit when trading Forex. You don't trade Forex as a single unit, but you trade Forex using lots, and that's how you make good profit. So that means that the Forex broker cannot take an order of $1. They take an order of a whole unit that is referred as a lot. The broker won't take 0.001 of $1, but they'll take it as a whole unit. So that 0.001 is a fraction, but the whole unit is now when you apply the lot size. The broker has grouped the orders in terms of bundles, or what we call lots. So whenever you want to buy or sell currency, the broker will group that buying and selling currency in terms of lots, so you get good profits. These bundles have sizes. When you request a bundle of a particular size or a lot of a particular size, then the broker automatically knows to provide you with what you want in this case. So it now depends with what lot size that you want to trade with, the types of lot sizes. First one, there is a standard lot, and the standard lot is the largest lot size and represented by 10,000 units of the base currency in a currency pair. For example, if you're trading Euro USD, then you must get this one right. If you don't get what a lot size is, then you will be having problems when you want to trade Forex. If you're trading Euro USD and you buy one standard lot, then you're buying 10,000 euros. Therefore, one pip would be worth $10 because it was 20 pips. Then the 20 pips became $20. But this one now becomes, one pip is worth $10. So a mini lot is 1/10 the size of a standard lot and represent 10,000 units of the base currency. So if you're trading a mini lot or USD, then you're trading 10,000 euros. So one pip would be worth $1. And the same as a micro lot is 1/10 of a mini lot, and a mini lot is 1/10 of a standard lot, and 1/10 of this then becomes this. Then becomes this. Then 1/10 of this then becomes 1000 units, which now the pip, 1 pip will now be worth this. So example of lot size calculation. You want to trade Euro USD, which is 1.23276 through buying transaction. Then Euro USD, we want to trade with 1 lot. Then this is now the ask price. So when you want to buy 1 lot, then that will be this amount. And this is a huge amount that you may not have in your account. Let's recap. You want to trade Euro USD of this through a buying transaction. Then Euro USD 1 lot. Then we've seen that 1 lot is equal to this amount in euro. The ask price is 1.23276. So when you want to buy 1 lot, then this one will be amount, which is a very huge that you may not have in your account. So the broker only trades in lots, but you don't have this kind of money in your account. How can you still trade in the forex market with such a requirement? Yes, you can still do. That's when we introduce what you call leverage. So now this is the summary of lot sizes, and 1 standard lot is equal to these units and is represented by this, and the value is 10 per pip, and it ranges between 1 to 100, and then mini lot comes in. This is now the base currency. This is the representation, 1 pip, the value is 1 pip, and it's 0.1 to 0.09, and then the micro lot is 1000, 0.1, 0.01 per pip, dollars per pip, and this is now the range. That marks the end of our representation. We'll find more what a lot sizes is and what is the leverage is according to the lot sizes that we have. See you in the next video when we'll find out how we can calculate now the lot sizes and the leverage.